Hi, Armando Roman with Axiom Founders Family Office, here with Sam DiPietro, attorney with the law firm Spencer Fane. Sam, how are you this morning?
I'm doing well, Armando. How are you?
Good, good. Hey, Sam, I'm looking forward to this conversation with you. You and I have overlap in the types of clients who we serve, and when we meet them. And what I find is that when we meet them, which is right before or after the sale of their business, often they're certainly in that mindset to have a conversation with you. And so we meet them kind of at the same time in their life. They've got these big things going forward and coming, and so they've got a lot of questions and they've never been in this territory before. So, um, you are, of course, an estate planning attorney. You're also a CPA, and you are helping people with their estate planning when they're going through some of these very major decision points and turning points in their life when they're about to sell a company and they're thinking about that next phase of their life and the future generations, their existing children, adult children, minor kids, and that. Uh, we, as their multifamily office and family CFO, we help them navigate those same areas as well, where they're thinking about they don't want to ruin the kids, they want to take care of the kids, they want to reduce taxes, preserve their wealth, and there's a lot that they have going on. And often with the business sale, it's all happening so fast that they don't have a chance to take a step back and take a breather and really absorb and maybe think um, as well or as clearly as they might like because it's just happening so darn fast. So what we'll go through this morning, I'll pull up the outline here of what you and I talked about. And the outline here that we can see now on the screen is, of course, tax mitigation and estate planning for the founder about to sell their business. And the outline is as follows here. We'll have a conversation about taxes, about the impact of the entity, some specific things, very, very specific to selling a business and the tax impact of that. We'll then talk about in the middle section here about trusts, the broad picture, a lot of misconceptions people seem to have about trusts, about asset protection versus not protecting assets. And then there's is always a concern for the family, of course, about protecting their adult children. How do they do that? And when I say protecting, I'm not meaning put them in a cage to protect them that way, rather than how do we protect them sometimes from just things that happen in life. And so this is the outline that you and I, of course, will go through. So why don't we begin, Sam, with with taxes? And I'll ask you in the broad picture, as you're helping people with that tax conversation, in the broad picture, what does that sound like when you're talking with your folks as you're helping them with their estate planning?
Yeah, no, definitely. And one of the things I do want to add that I was excited about this podcast is all of this stuff, as you've kind of said, planning for an exit, planning for the estate plan, planning for how kids will inherit wealth and asset protection. It's a lot to throw at someone, especially if they're on the roller coaster of selling their business. So to your point, Armando, the extent that we can get people in front of us before, they start to get on that roller coaster of the M&A transaction, I think that it's beneficial because as you can kind of know when you've got 10 fires going at once, it's not a great scenario to be in to put them all out. So starting the fun conversation on death and taxes, I like to joke there. What we usually look at from a tax perspective when you have someone that's about to exit or planning to exit a business is a couple of different things. Obviously, foremost for me, because this is what I do for a living, I look at estate taxes. I say, okay, do we expect to have a taxable estate either today, pre-sale of the business, or post-sale of the business?
Right.
And a lot of times, business valuation is kind of fun. And what I mean by that is founders, some of them will think that their business is worth 10 times what they'll get, and others think that it's worth nothing. And it's kind of, the Goldilocks, I guess, has been between that. And so it can be somewhat difficult to tell if you're going to have an estate tax issue or not. But what I tell clients is when you're in the scenario when you don't know, it's best to at least have the discussion on, okay, techniques that we might use or might consider using to mitigate it. So again, starting with the estate tax side, we'll look at, okay, is there planning opportunities there? Generally, there are things that you can do depending on how far away you are from selling the business. And what I mean by that is if you're 6 months out, there's a lot of stuff that we can do. If you've
Right.
already received a letter of intent, it becomes less of a how do we plan before the exit of the business, and it goes a little bit more to planning after the exit of the business. And what I mean by that is that letter of intent or that agreement that kind of fixes the price. For my purposes, it kind of fixes what I can do to the extent of pre-exit planning. And so one of the jokes that I tell clients a lot when I present on this topic is, a tale of two clients that happened to me a couple of years ago. One, they came 6 months before the exit and they exited at around 50 million. We were able to do some extensive planning to mitigate the estate tax burden. The other client who came to me after the exit exited at about 90 million. And what I tell you is it's a lot more difficult to fix a $90 million estate tax problem than it is to preemptively address a $50 million potential
Right.
estate tax problem.
Right.
So again, starting with the estate taxes is where I would go. The next thing that I think you always have to look at is, okay, income tax planning, right? What can we look at in terms of income tax mitigation? People tend to, in my experience, really like the income tax side a little bit more than they like the estate tax side. Obviously, the estate tax side, you might not get to see the benefits because it's really your kids or
Right.
spouse that are getting the benefits. But from the
Right.
income tax side, it oftentimes is the client that's getting the benefits. What that involves from my side is working closely with the CPA and financial advisor to make sure that there's other items, say that they can generate losses in that year, that they're doing that to maybe offset the capital gains. Looking at something called qualified small business stock, which is a topic that we're going to address a little bit briefly this morning.
Yep.
And it's one that, quite frankly, I see missed quite a bit, which is kind of scary. Sometimes clients will also want to say, okay, is there a way that I can shift some of the income tax liability outside of my state of residence into a more tax-friendly state? And so what
Right.
I mean by that is if you're in California or, another state that has a high tax rate at the state level, it might be saying, okay, is there a technique that I can do to say move part or all of the sale to a state like Nevada, which has a very low tax rate? So it's
Exactly.
kind of a holistic, planning. And what I tell people is, again, it's a lot of steps that I just mentioned.
It
If
is.
you're asking me the week before you sell the business, we probably can't do all those steps, but 6 months out at a minimum is a good thing to have.
Exactly, and you make a good point that planning ahead is so crucial in this whole thing. Let me talk about type of entity for a bit, because people will ask this question quite a bit.
Mm,
Does the entity of choice for the business matter? Well, yes, it does, and there's some things that can have an impact on that. There is what's called qualified small business stock. There's a capital gain exclusion of about $10 million, and that recently changed with the new law that went into effect in July of 2025. So whether that applies or not, it certainly is worth investigating if there's a possibility that you can exclude capital gains of $10 million. Well, you better darn well have a little bit of time to investigate that and make sure that it can work for you, or at least do enough digging to where you feel confident that it doesn't work. Because with a substantial sale, $10 million of capital gains is a lot of money, and compounded over time, it makes a big difference. So yes, type of entity, it does matter whether it's a C corporation, an S corporation, a partnership. One of the questions that we'll also hear is an asset sale versus a stock sale. And that, those words can be confusing to folks at times. An asset sale, of course, meaning that if the buyer is going to buy your company, they're going to buy the stuff. They're not going to buy the entity. And part of what they will want to have is they want to buy the value you've created, but they don't want to take on any liability that you might have built up along the way, or that sits there quietly dormant till it surfaces. So the way they avoid that, or one way they try to minimize that risk, is they look at an asset sale rather than a stock sale. Because with a stock sale, of course, the buyer takes on all of the liability that might be with that existing company, and they don't necessarily want to do that. The seller might have a different perspective, because from the seller's perspective, there are some tax advantages to a stock sale versus an asset sale, but that's all part of the conversation. Getting back to your point that, hey, when we have time to plan in advance, then we can address these issues and ferret them out, and that all becomes part of the negotiations that take place between buyer and seller during the final stages leading to closure on that business. And you mentioned the state income tax. Some states, of course, as Florida, Tennessee, Nevada, they don't have any state income tax. So if you live in a high state tax a high tax income tax state like California, or maybe New York is another one that's pretty expensive as well, then can you shift some of that income up from the sale or capital gains from the sale over to a no tax state? And that are the ways to do that. I'd say yes. I know we've got a client now who has done some of that planning before we met them several years ago. And now we're working with the tax attorneys and the tax CPAs to make sure that that strategy is in fact going to work. And if not, what do we do leading up to sale that can work for them to help minimize and or reduce or even eliminate some of those taxes that might be there? Sam, in the tax conversation, to kind of put a cap on the tax part of this conversation, at least for this time, anything that we didn't touch on that comes up in your conversations with families as they're leading up to exit that we really need to touch on?
Yeah, I mean, if we have the time, I would love to talk a little bit about 1202 stacking, the qualified small business stacking. And again, I'll keep it high level.
Yep.
But I mean, to Armando's point, and a little bit of history on 1202 for those that have no idea what I'm talking about. Congress in the 90s, they wanted to encourage investment in small businesses. And so they passed a bill that basically had this provision for qualified small businesses. And there's, high level criteria, has to be a C corporation, have to have held it from original issuance for a couple of years, also have some asset limitations. But what we've saw with this new administration is a much more friendly administration than we've seen in the past with regards to qualified small business stock. And what I mean by that
Yep.
is there's been some administrations in the past that have tried to get rid of it, but this administration has not tried to get rid of it. Instead, what they've done is they've made it easier, and they've even increased that exemption, that 10 million that Armando spoke about, to 15 million, which is really powerful. That means as a taxpayer, if you have a C corporation that meets the requirements, you can exclude 15 million. What a lot of people don't necessarily plan for, people that are willing to say make transfers to descendants or spouses, is that there are ways to duplicate that 15 million through irrevocable trusts. And again, I don't want to go too far into the weeds, but that concept is called qualified small business stacking. And it really is a powerful tool if you are planning an exit
Right.
with a C corporation that qualifies and you want to leave items to either children, spouses, etc. There are ways to do that that might actually be able to let you exclude much more of the gain, if not all of it. So that's something that I will see a lot of times. And again, the stars have to align. It has to be a C corporation, which, fell out of popularity a little while ago, but maybe now is rising, have to meet all the criteria. But if you do, that's a really powerful tool to eliminate quite a bit of taxes with very, very little risk because, again, it is a code provision.
Right, exactly. I'm glad you mentioned stacking. That is such a key word that can be significant for that family going through the exit. And when I think about in the big picture, Sam, reducing or eliminating taxes on any kind of an event, what I like to look at it is not just saving the taxes, because the families that we work with are typically very, very generous people. And when
Mhm.
they have more that they now have after the sale, they can give more and they put that money back into the community. And that gets to the impact of charitable giving and charitable planning as you go through an exit as well, because that is another strategy, another technique that can be extremely impactful, not just from a tax saving standpoint, but from that entire family's holistic viewpoint of how do the parents who had this exit of the company, how do they continue to engage the kids in philanthropy, in charitable giving, and help the kids understand how important it is that when they've been blessed with this kind of a fortune, that it's important to share that with the community and have an impact on the community that they want to have. Engaging the adult kids and maybe the grandkids in that giving can be extremely, extremely impactful. So, Sam, let's go to trusts now. And when I think about trusts, you of course are the estate attorney. You draft these things. I don't. I read them and I get confused because people like you who have law degrees have written this and you understand all these clauses and that. Talk, if you could, in the big picture about trusts. And I'd like you to touch on, if you would, revocable versus irrevocable trusts. There seems to be a lot of confusion that a listener might have on what those trusts are and the whole asset protection component versus no asset protection component.
No, exactly. And it's a wonderful topic to touch on because at some point or another, almost anyone on this, listening to this podcast will be told that they need some type of trust, and likely just because of the convenience of it. What we'll talk about kind of starting with is revocable versus irrevocable. So at a high level, what is a trust? It's really an agreement between two people regarding the management or disposition of assets. And so parties to this agreement, you'll usually see three. And again, there can be more, but for simplicity, we'll talk about three. You'll see the grantor, which is the fancy name of the person that actually creates the trust. They put the stuff in it. We'll see the trustee, which is the person that follows the rules that the grantor sets. And that means, the grantor could say, trustee, you can make distributions for XYZ. The trustee is the person that will follow those rules and has the duty to the beneficiaries to make those distributions. And so the last party in that three party is the one that everybody wants to be, which is the beneficiary, the person that actually benefits from the trust agreement.
Yeah.
So again, any trust will have at least those three parties. Now, the distinction between a revocable and an irrevocable trust is with regards to the grantor's ability to revoke the trust. And what I mean by that is a revocable trust is purely what it says. It's a trust where the grantor, if they have the capacity and if they have the desire to, they can revoke it. They can terminate it. They can tell the trustee, I don't want you to administer this trust anymore. I want the stuff back. Or they could say, trustee, I'm going to change the terms of this trust agreement to be whatever I want it to be. From a income tax side, a revocable trust is basically just disregarded. I tell people it's almost like a single member LLC. They don't typically have their own EIN. I have seen some that have. I don't know why you would, but again, you don't have to have your own EIN. It all flows through your personal tax return. And perhaps the biggest kind of misconception about revocable trust that I see, at least in my practice, is people will come into my office and say, oh, well, I'm protected if I get sued because I have a revocable
Right.
trust. It gives
Right.
me creditor protection because it's not me. And then you have to explain to that client that under most states, like Arizona, for example, the revocable trust really is just you. It doesn't offer any asset or creditor
Yeah.
protection. What it does do, though, is it's a probate avoidance tool, which means that if you were to pass away, that stuff doesn't typically have to go through the probate court to move it on to the beneficiaries because you've titled that stuff. Say you had a house. Instead of having it in your name, you'll have it in the revocable trust name. So you pass away, we don't have to go to court to retitle that in the name of your beneficiaries because you've already done it during life. You retitle it in the name of the trust, and the trust lives on after you die.
Yeah.
And so when I say that a lot of people on this call will discuss with somebody the need for a trust, that's typically the starting point is the basic revocable trust that will get you that probate protection.
Yeah. And Sam, let
Mhm.
me ask you to hold for just a second there. So I just want you to repeat what you said because this I see this over and over again. Just as you said, people have a revocable trust and they believe their assets are protected. They think they have asset protection, creditor protection. They think that if they get sued, everything that is in the name of that trust is protected and the lawsuit cannot take it. And that I'd say is an enormous misconception that people have. So a revocable trust, typically, at least in Arizona where we live, does not provide any asset protection, right?
Exactly. And so that's not its intended use. Again, its
Yeah.
intended use is probate avoidance and then an administrative vehicle for how things pass to the beneficiaries.
Yeah, yeah. So really, it sets things up so that what we'll tell families is the revocable trust sets things up for when you die. It doesn't give you any asset protection. If you get sued, those assets are still at risk because they're still in your name, in your control, as you said. They have control over those assets, but it sets things up so that when you die, then those assets will transfer to whomever you've decided. And as you said, they can avoid probate court as well because that trust has been set up and the assets have been retitled into the name of that trust, right?
Exactly that.
Okay, thank you. And so irrevocable trusts or irrevocable trust, I have trouble pronouncing that word. But either, however you pronounce it, irrevocable trusts mean you've made a decision. You, the owner of those assets, you made a decision. You cannot change your mind. You put those assets into some other entity, some other legal entity, and now you have relinquished your control typically of those. They now belong to something else, a trust that has been set up, right?
Yeah, they're the fun ones, for my for how I explain them. They can accomplish a lot of things that a revocable trust cannot accomplish. And what I mean by that is, depending on the terms of the trust, you could get asset protection. You might also get estate tax protection, and sometimes there's even income tax benefits of having this type of trust. Now, to Armando's point, there are more restrictions. Purely, revocable trust, you can change the rules any day of the week. An irrevocable trust, it's much more difficult to change the terms, at least from the grantor's perspective, to be able to modify it. And so that's the one, again, where if you talk about taking the time to get something right, you really do want to spend the time to get something right with regards to this vehicle. So if you had a client that was going to exit a business and they said, "Oh, I heard that it's great to do an irrevocable trust. I want to get it done tomorrow." It's probably a client that you want to tell, we might want to spend more time to get it right, because once you lock it in, it
Right,
might be impossible to close Pandora's box if it's Pandora's box.
right, exactly. And then Sam, the another misconception that I seem to hear as I talk with families about their trust and estate planning is that each state has its own rules and its own ways that it handles trust. You mentioned, for example, Nevada. Nevada, I hear Nevada, Wyoming, Tennessee, South Dakota, other states as well, that people will sometimes set up trusts in the state of Nevada because of anonymity, because of no state taxes. Can you speak to that a bit so that the listener who is thinking this is all Greek, why might they want to look at some of those other states to set up a trust? What are the benefits or advantages of thinking about that?
Yeah, exactly. And that's kind of the fun thing about my industry, is that a lot of states are starting to compete to get people to open up trusts in their states. And so what that looks like is a couple different things. First, and perhaps foremost for a lot of clients, it's asset protection. States like Arizona, for example, if I created an irrevocable trust for myself, that wouldn't get me any asset protection. It's basically what's something called a self-settled trust, and it's just
Yep.
disregarded for asset protection purposes. States like Nevada, South Dakota, and Alaska, what they are known for is saying you can set up those kind of trusts in our states and we'll actually give you some credit or protection from them. Another bullet, and this is one that a lot of times will be overlooked when estate planning attorneys talk about trust, but it's something that's very relevant, is the ability to have what's called a silent trust. And what I mean by that is, if you create a trust in Arizona, the beneficiaries have rights to request information. They might request a copy of the trust agreement as it pertains to them, administration regarding how the trustee is handling things. And if your beneficiaries are, say, 18, early 20s, you might actually want them not to have that kind of information. You might
Yep.
be creating the trust to avoid estate taxes, but not necessarily to create trust fund babies, right? Beneficiaries that are going to rely when mom and dad pass away to get the stuff.
Yep.
States like South Dakota and Nevada will have silent trust provisions that will let you basically say for a period of time that the beneficiaries are not entitled to notice of the trust existence. They're not entitled to trust records. A lot of families that are high net worth that have younger children that they want to encourage to be ambitious and make careers for themselves,
Mhm.
they like those kind of provisions because it accomplishes the estate tax planning goal while also lets the beneficiaries have the time to actually learn how to develop themselves without having to think about, oh, I'm going to inherit millions when, mom or dad pass
Right,
away.
right. I'm glad you brought that up. When we meet with typically our clients have the business, they're selling the business, they're the first generation in their family to really make some significant wealth. And the last thing they want to do is ruin their kids and make them into quote unquote trust babies who depend on that trust to eat their meals every day because that's where all the money comes from. So we will encourage them to not share with numbers with the kids. So what you said about silent trusts, we don't really want the adult children to know how much they're going to get because we don't want to disincentivize them to go to college, to work hard, to build their own families and become productive, people out there who are doing good things in this world. So the silent trust, uh, being able to keep that information from them, not to necessarily protect them, but really to not ruin them or disincentivize them to work on that. I do like that idea quite a bit. And so, what about anonymity as well? Some of the states have this anonymity that they promote. Talk about that, please.
Yeah, so a lot of clients, especially in my experience, celebrities, law enforcement, they really want to kind of shelter what they own from either creditors or prying eyes. And so some states, quite frankly, have better anonymity laws than, say, Arizona. If you've ever pulled an Arizona deed, for example, that has a trust on it, part of the requirements for a deed is that it actually names the beneficiaries of the trust. That might not be desired. And so sometimes what some families will do, and again, it might not be even be for the estate tax protection or for preventing heirs from getting information, they might choose a state like, say, South Dakota, for example, or Nevada, that it's very difficult to access court records or it's very difficult to figure out who actually owns what. And again, it's not usually something nefarious. It really
Right.
is people that, again, celebrities are excellent examples that have legitimate reasons for wanting to shield prying eyes from what they own. I've got a few cases from clients where they didn't have this set up, and all of a sudden, the next thing you know, fans are knocking at their door at the early hours in the morning. That's not ideal. That's not necessarily what
Right.
they want. It
Right.
provides some shelter between their personal life and then their professional careers.
Right. And it's not that they're trying to hide or get away with anything
Mhm.
that's under the table or
Exactly.
is it nefarious or illegal or that. It's more of they want to protect their privacy. And I've had many conversations with an attorney who does a lot of asset protection. And what he has drilled into my mind is the term target value. And target value, not to laugh about it, but it makes perfect sense when he described what target value is. He said, if people know how much you're worth, that is your target value. And that is what they will go after if they're going to sue you. So why let people see that? Why let people know that? Instead, keep yourself anonymous or keep yourself protected. And there's no need to have people know what the heck you have and that when it's none of their business anyway. So protect yourself by keeping things quieter, more anonymous, and attract less attention because the more attention you attract, the more possibility there is that there'll be some kind of a lawsuit, frivolous or otherwise, that is going to be not what you want at all for yourself or your family.
No, exactly. And when I present on this topic of asset protection, what I tell clients is you kind of want to make yourself a porcupine, right? You want to make yourself in such a way that people don't want to get too close in terms of getting poked. And so, to the extent that these strategies help, I think that they certainly do. And what I will tell clients is asset protection is not a yes or a no, I'm protected. What it sometimes looks like is a gray area. And what I mean by that is if you get sued, you have these structures in place, someone sues you, say, for $1 million, they might be willing to settle for $100,000 because you look like a porcupine. You look like something that they
Yeah.
realize that they might be in court for years and they might ultimately lose. In that case where you settle, what I'll tell clients is that structure actually did work. It made you less attractive. It prevented this lawsuit.
Right.
So it's not an all or none, but it certainly puts you in a state where it's much better to have that in place before you get sued than to all of a sudden get sued and you have nothing in place.
Right. And to add on to the point you just made about that, I spoke with a personal injury lawyer a long time ago, and he said, hey, what's important for you to understand, Armando, is that when there is some kind of a personal injury lawsuit, the personal injury lawyer first looks at the insurance policies in place. So one way to help protect your clients and your families is have very high limits on the insurance policies, because in his words, that's the easy money to get. And sometimes when the other side gets the easy money and they call it a day, they leave you alone. So having high insurance limits can be very helpful to just, as you said, the porcupine effect, you know.
Hmm. I'll trademark it. Yeah. Uh-huh.
Another way to do that is to have those high limits on insurance policies to, again, let them just get them out of your business as soon as possible. You mentioned about grantor. Actually, I want to talk about, Sam, grantor and non-grantor trusts. And what I'm really thinking about is the way those are handled for tax purposes, because it's an area that I see confusion on. And just to touch on what those mean, of course, a grantor trust means that whoever sets up, whoever is the beneficiary and trustee of that trust, the assets can be in that separate trust, but all of the taxable income, the interest, the dividends, the capital gains, all that, it gets paid by the beneficiary and or the trustee. So the trust itself is not the one paying the taxes on those. That's what the grantor trust is. And on the other side of that is the what's called the non-grantor trust, where it is in fact paying all the taxes itself. So if it has interest income, it pays and files its own tax return on those as well. I bring that up because we see that from time to time. And at times when we first look at those trust documents, it isn't always clear if it's a grantor versus a non-grantor trust. And it just, to me, just adds to the point you made early on in our conversation that planning well in advance of an event gives you time to think about all these options that exist and helps you make the decisions that are really best for your family going forward, beyond the sale of that business.
No, it's exactly that. So the grant, just to recap what Armando said, a grantor trust simply means somebody else is paying the tax bill. A non-grantor trust simply means that the trust itself is filing and reporting its own taxable income. What you'll usually see is clients, and again, this is what keeps me employed, is they don't know per se what their trust is. They've been told, but I actually, and just to kind of tell a funny side story, I had a CPA firm once that hired me to actually go through the trust that they got from clients and make a determination as to whether they were grantor or non-grantor trusts.
Okay.
It involves a close reading and looking at the powers to see, okay, what triggers that status, but it can have big tax effects. And what I simply mean is that if it was a non-grantor trust and you've actually been reporting it as a grantor trust, well, then the trust hasn't been filing its return. Or, the vice versa. If you think it's a non-grantor trust, but it really is a grantor trust, that means that you have been incorrectly filing your return. And so getting it right is very important, especially as you approach selling a business if the trust has any ownership interest in the business, because that's going to determine where that tax liability from the sale flows through. Is it going to flow through to the trust, or is it going to keep on flowing through to you, the person that created the trust? And how does that impact your tax liability? And so, for example, this is, just to give a kind of a horror story of it, right? If it's a grantor trust, there's a huge tax bill. The trust has all the liquidity because the trust owns the business. You might not have any liquidity, but now you're responsible for the tax bill.
Yeah.
It's planning to say,
Right.
okay, how are we going to pay that tax bill that you're now personally responsible for when the trust has all the money?
Right. Right, exactly. And it just drills home the point again that, the reason, as you said, the reason you're employed is this is not a simple black and white, here's how you do it. There's one way to do it. It's kind of the opposite because of the different states that you can set up trusts in, the different states that have income tax and some have no income tax. And then what is the family really trying to get to as they navigate this whole once in a lifetime sale of the business? And let me make sure I'm looking at my notes here to make sure we didn't miss anything on that part of it. Oh, one of the things I hear also, Sam, is when I have this conversation with families is many times people are not ready to give up control of the assets. So they seem to understand that they can get better protection for the overall family net worth when they set up a trust, say an irrevocable trust, but they're not ready to give up control of the assets. And I've heard that over and over and over again. And I would think as you have that conversation with your, with your clients, you're having that same conversation, and there are ways that they can still get that protection and retain control. And that might mean looking at different states for how they set things up. Can you touch on that, please?
Yeah, certainly. That comes up at quite frankly almost every conversation with the business owner. And what I always start this discussion off with is saying you never want the tax tail to wag the dog,
Yeah.
right? I mean, I can give you the best tax avoidance strategy in the world, and that's give it all to charity, right? That'll mitigate your taxes for sure, but that probably won't achieve what you want to achieve. And so it is kind of looking and saying, and this at least my practice is giving several different options with pros and cons and discussing them both. If the concern is I don't want to give it up because I need the income stream, that might be changing the structure from, say, a gift to a sale, where all of a sudden you do retain an income stream over the asset. If the conversation is no, I actually want to have some kind of managerial control over this item, it could be structuring it in such a way where you're the beneficiary of a trust that has, say, the managerial control, and then your kids are the beneficiaries of trusts over that own assets that don't have the voting or managerial control. It really is kind of taking your goals and then finding a structure that meets them. What I like about my job is there's a lot of different things that you can do. Yes, there's pros and cons to both, but what I tell clients is at the end of the day, and this is, something that I will tell clients often when there's kind of a stalemate, is there is a plan because state law does have a plan. You just don't know what it is. And what I mean by that is if you pass away without any documents, the state of Arizona, we do have a plan for you. It's called our intestate provisions. You probably haven't read it. And so, to the extent that you actually want to know what's going to happen to the business or what happens to your stuff and you want to control over it, spend the time to get the plan in place.
Yeah, no, that makes a lot of sense. We had a meeting last week in the office here, Sam, with we have a client who's going through exit right now, and it'll be pretty sizable. So we had a meeting with a tax attorney to talk about his contribution was the 1202, the capital gains exclusion, the stacking, etc. In the meeting also was another attorney who's a tax attorney and merger and acquisition attorney. So he's the one who helps to draft the agreements and negotiate the sale of the business. Also had an estate attorney in the room whose concern, of course, is the family and protecting the adult children and getting trust set up for them. We had a tax CPA in the room as well. Actually, had two CPAs in the room, but a tax CPA who's looking at the overall business tax returns, individual tax returns, and the tax impact going forward. Had myself, who's a former CPA of 30 years, and as the family office CFO, the multifamily CFO for families, helping them protect their net worth and preserve what they have. My perspective is that family. How do we get them to where they want to be with now paying exorbitant amounts of taxes and protecting what they have going forward and taking care of the family that they want to going forward. And then my business partner, Tom Markey, was also in the meeting as well. So we could talk about the financial planning, the cash flows for them for the next 30, 40 years of their lives and then beyond. So we had this meeting with one, two, three, four, five, six people in the room to talk about this family that's going through this major sale of a business, because all those heads were required together to have that conversation, truly have that dialogue amongst each other to get to a place where we could understand and come to some decisions on what does make the most sense for this family, given what they are trying to achieve. And I'm sure you see that as well in your practice, where as you said, involving the financial planner, involving the tax CPA, because this is a better outcome for the family when the heads come together to talk about that family situation.
No, exactly that. I mean, I'll tell you where I see the mistakes made the most is when professional advisors are siloed. If you don't have
Yep.
the attorney talking to the CPA, talking to
Yeah,
the family wealth advisor, things are going to get missed, especially for these higher net worth families that have a
exactly.
lot of complexity. Sometimes my favorite thing is when people come into my office and they say, "Oh, I'm a really simple case," and then I know by that they're not a simple case. Everything is with what we do, one thing will affect, it's a domino effect. One thing will affect things down the road. I might see again the estate side of it or even the tax side of it, but I might not know what the retirement plan is, what the goal of the family wealth is in 10 or 20 years. That's when you need to loop in the other professionals to kind of assist with those areas.
Right, exactly. You need that multidisciplinary approach because everyone's perspective is extremely valuable in those conversations. And when the dollars are even, more significant, it's even more important. So let's shift to the last part of this conversation about protecting the adult children. I've got that outline up here again on the screen so we can see it. We'll talk about community property, sole and separate property, trusts for the adult children, types of trust for the children, and then special needs trusts. So I'm going to now take that off the screen so we can talk about that a bit. And let's talk about we live, of course, Sam, here in Arizona. We are a community property state, and one of the I'd say sources of confusion here is sole and separate property versus community property. And I just had extensive conversations about this with several CPAs, and there was just confusion there that highlighted to me that it is not clear how this really works. So, can you talk about community property in Arizona specifically, since we both live here, and just what is community property?
Yeah, no, and that's, I mean, I wrote an article about this a couple months ago, the difference between separate property and community property and how crossing state lines can have a very big impact. So, for example, Illinois, where I'm also licensed, they're a separate property state, whereas Arizona is a community property state. And what that means is in Arizona, the presumption is married couples, you take all your stuff and you put it in a blender, right? It's all 50-50, but it's so intermingled that you can't unwind it. There's tax advantages for doing that, but the tough thing, especially when it comes to family businesses, is absent protections that what would be separate property, and what I mean by that is property that's not put into that blender, could all of a sudden become put into that community property blender when a child is married. And what I will say is, kind of distinguishing again the community and the separate, in Arizona, you can have both. Separate property typically looks like property that was inherited, received by a gift, or that you own pre-marriage. The
Mhm.
risk, though, is this concept that's called commingling. And for my analogy, commingling is when you start to put it inside that blender and hit blend.
Yeah,
Is yeah, that business might have been your separate property before you got married, but what about the appreciation that occurred post marriage? All of a sudden, is that appreciation community property? And is there a way for me to basically track what the value was when you got married versus the value was when there was a marital dissolution and determine what was separate and what was community? Maybe or maybe not. And that's where you get the family law attorneys in. And as you can imagine, that's an expensive endeavor.
right,
So, to Armando's point, to the extent that you can plan, and again, nobody wants to plan for something like divorce, but the statistics are what they are. That, it's,
right,
I think it's 52-48 now, marriages that end in divorce versus marriages that don't.
right,
The extent that you can plan to avoid that expense and that anguish of trying to separate stuff that might be in a blender, you save a lot of time and money and also, headache.
right. And I'll mention just a little bit of a side note. You mentioned about divorce rates. Years ago, when I had my CPA firm, we had a law firm that were divorce lawyers, and this would have been about, I don't know, 2005 or something like that. But I bring that up because they taught me that in the United States, the county with the highest divorce rate per capita at that time was Maricopa County, right here where
Mm.
you and I both live. Why? Who knows why? But that was the reality at that time, according to the divorce attorney experts. And I bring that up, as you said, nobody wants to plan for divorce. But as you said, the facts are what they are, and the divorce rate is fairly high. And that gets me to the sole and separate property conversation. You also said that when somebody goes into a marriage, whatever they had before the marriage can remain sole and separate property. And you mentioned specifically gifts or inheritance, that those are sole and separate property. And I think what you were saying is those are sole and separate property even if they're married at the time, those remain sole and separate property as long as they are kept in separate accounts or accounted for separately. Is that right?
So it depends on the asset, right? And what I mean by that is, again, if it's a business that you're actively involved in, your, your activity post marriage, right? That's community activity. And what I
Yep.
mean by that is, you could have been working at, say, a law firm and earning a paycheck there, right? That would be community property. So that portion of it, at least arguably, would be community property. But with regards to whatever was pre-marriage, right? So say the business was worth 10 million pre-marriage and 5 million post, right? The 10 million pre-marriage arguably would be sole and separate, and the 5 million post could arguably be community because you were putting efforts into that.
Yeah.
But to your point, Armando, another area that we'll see people kind of really getting themselves into traps is, say you, instead of a business, you had a bank account, right? You have a bank account that has $1 million in it. Pre-marriage, you get married, you take that $1 million, and all of a sudden you throw it into the joint bank account. That's very tough. And what I mean by that is that was arguably separate property, but say 10, 12 years go by, it's in that joint account. How do I unwind what that
Right.
$1 million was
Right.
versus, what is community in that account? And a court might just say, no, at that point, we can't trace it back and we're just going to treat it as community. And so the point here is, if you can keep it segregated, whether that's through a separate revocable trust, a prenup, or a postnup, to the extent that you can segregate what is separate and what is community, that will save you a lot of headache down the road.
Yeah. We had a new client come on board, Sam, several years ago, who had a beneficiary trust. And so her parents had set this up for her. So now she had a beneficiary trust. She was married, one longtime marriage that she had. But when her parents died, now this beneficiary trust had the assets that parents had left for her. And so our client, the woman, um, these assets were sole and separate property. That's how it was set up, and it was maintained in a separate beneficiary trust. And the CPA who referred them to us told client and told me, I don't see any reason to have this beneficiary trust. All it does is cost you more money. It's just an extra pain and expense. Get rid of it.
Hmm.
That was what the tax CPA was telling client and telling me. In my meetings with that client, with that married couple, it was very apparent that the woman sat in my conference room one day as we talked about this, and she looked me in the eye right across the conference room table from me. And she said, looking directly at me, Armando, you don't understand. I have to protect this money. And then she repeated herself, Armando, you don't understand. I have to protect this money. And what she was telling me is she had to protect it from the man sitting next to her, her husband. And every time I called her, he would call me back. She wouldn't. I email her, he would email back. She wouldn't. When they came in to me, it was he was always with, he would always answer questions for her. I reached back out to the CPA and said, "Hey, this is what's going on. that I'm afraid that she is worried that this beneficiary trust that's been set up for her, that he wants these dollars and he's trying to get these money. So I'm calling you to say we are not going to shut down that beneficiary trust. We're going to keep it as is. It's her sole and separate property. That's what was set up for her, and so we're going to respect what was already set up for her, and that is what your client wants, what our client wants." I bring that up because it really speaks to that sole and separate nature of the inheritance that she received from her mother and father. And if mother and father were maybe to redo that for her, they might have put a corporate trustee in place for her rather than making the woman her own trustee, where now she had this undue pressure from her spouse to try to get access to those funds. Thoughts and comments about that, Sam? What do you think?
No, I mean, it's exactly that. You plan obviously to protect your kids, and one of those protections sometimes is protecting them from a divorcing spouse if things go wrong there. I have seen clients that, yes, they have used the corporate trustee because it makes it a little bit easier for, child to say, well, gosh, I don't have any control of this. Mom and
Exactly.
dad appointed XYZ trust company. I
Exactly.
like that. Sometimes what you'll see in the document itself is that it will require things like a prenup or a postnup, right? For the daughter to say get principal distributions or something like that. That can be nice because it can sometimes make the conversation between child and spouse a little bit less that I want a prenup. It can be a
Right.
little bit more of, no, my parents said that to get the benefits of this trust, I have to have a prenup.
Exactly.
I think that
Exactly.
that can take a lot of pressure out of it, because I mean I've spoken to many clients and kids of clients that have just said, if I tell my spouse we have to talk about a prenup because I want one, that's going to cause a lot of heartache. I
Exactly.
think to the extent that parents can plan to help kids navigate that, I think that's a nice thing to do.
Yeah, I agree. I agree. And the more we can, as you said, when the spouse is saying, "Hey, I have no control over it. This is what my mom and dad did, that I don't have any control." Well, then that's true. That's true as long as mom and dad set that up so that
Hmm.
the adult child does not have control. And it's not necessarily so much to protect the child from themselves, but you just don't know what they're going to be faced with. You don't know who they're who the spouse will be and what that person's story is. You just don't know. You just don't know.
No, and I read an article I read a few years ago, which was really interesting. It was talking about the different distribution schemes for trusts. A common one that you'll see, and it's a little less common now than it was when the article was written, is you might say, a third gets distributed at 30, a third at 40, and then a
Yeah.
third at 45. The fun thing that the article was referencing is those are the most common ages for the first divorce and then the second divorce if there's going to be one. And
Oh,
it's not great.
oh wow. I didn't know that. Um, what about trusts? As people are having that big liquidity event, they're going to sell their company and they have adult children. They want to take care of the kids or their adult kids and or grandkids and protect them and set them up for success. They don't want to make them trust babies. How should, say, when you think about trusts for the adult kids, what comes to mind for you that say mom and dad might want to set up for the adult kids as they're about to have this liquidity event when they sell their company?
Yeah, a lot of that conversation, at least in my experience, resolves around the nature of the kids. And what I mean by that is if it's children that have already been successful and mom and dad want to set stuff aside as a way to avoid estate taxes, but also give them a lot of control over it, you might say, okay, have an irrevocable trust created for the kid where they're either the trustee or they have, a lot of investment power, say an investment advisor, something like that. They've got the power to change where it goes or whatnot, and the reason why I like that structure, especially for children that are, say, in high risk professions, right? So doctors, CPAs, lawyers, where liability obviously arises more common than other areas, and it's harder to, either insure against it or prevent it. A trust is a nice way to kind of backstop that protection for an adult child because they do get some creditor protection under, even Arizona law, right? You don't have to go to, say, a state for Nevada like that. And so I will see parents set it up that way for children that say, again, don't necessarily have the acumen to manage this stuff or are not in a stage in life where a big inheritance would benefit them. It might even detriment them. What I'll see clients is looking more for that kind of silent trust we talked about, right? Where they can actually start doing the tax planning without having to worry about the beneficiary, having some kind of detrimental effect by receiving a large, inheritance sooner rather than later.
Yeah, and let me thank you, and let me ask you a question. This came up recently. A business owner going through a sale who say has already, when they set up the corporation, they say given stock to some of the kids, and now that the company is about to sell, that stock is about to liquidate, and it's going to be something substantial. When that's already done, and now we're at the table to talk about planning for the adult children, who some may be married, some may not, what would you think might be a way to help protect those family assets that are now going to be liquid cash in the hands of the adult child who may be married?
Yeah, so then that's always an interesting one, right? Once the gift has already been made, you can't really unring the bell in terms of, protecting children that way. What I would generally recommend is, again, if it was property that was acquired pre-marriage that we can segregate, putting it in a separate revocable trust, right? That's that child's sole and separate property, just as a way to avoid commingling.
Yep.
That can certainly be a strategy that's employed. Again, you could say post-nups, but what in my experience, I found that if you can't get a client to do a prenup, you're not going to be able to get him to do a post-nup. It's
Right.
even less, and spouses have even less of a reason, I guess, to consent to it. So really segregating is the first thing that I would look at.
Yep.
You can also look at things of maybe making an asset protection trust. And what I mean by that is the kid actually taking their proceeds and putting it into an asset protection trust. Again, you wouldn't do it in Arizona, but a state like, Nevada, South Dakota, that could be a good way to do that to kind of both backstop a creditor or maybe even also a divorcing spouse from getting access. it kind of goes back to, again, if there was proper planning done, you could have had better solutions. But
Yeah.
sometimes, if they already own the interest, the ox
Right.
is in the hole, for lack of a better term, and you kind of got to plan around that.
Right. And that brings it to a point also, Sam, just what you said, that uh, people do things along the way and they don't always understand um, what they've done, or they did things because that was the recommendation at that time. And so they did it.
Mhm.
And when you and I take a look at that after the fact, maybe that wasn't the best thing, or what the thing that we would necessarily recommend, because now we have more limitations on what we can do for them going forward. But if they've already given that stock, and now the adult child has it, and that I like what you just said, a separate revocable trust can be a way to keep those assets segregated, keep them separate, and keep them as sole and separate property, right?
Exactly, because it provides a vehicle to trace, right? Because again, the issue that, at least what I've seen in my experience, is there'll be a marriage, then 10 or 15 years down the road, there's a dissolution, and all of a sudden you're going to a court and you're trying to argue that something is separate property. And what I mean by that is the presumption is it's community property until you can prove otherwise.
Yeah.
So having that vehicle that gives you the evidence to trace it back and prove otherwise is a very vital thing.
Yeah, exactly. And you also mentioned, if they're not going to do a prenup, then a postnup probably not going to happen either. And that makes perfect sense. I've seen that before as I've spoken with families, that sometimes the adult child just says, "No, I'm not doing that." And that's up to them, of course. At the same time, when I've seen the parents who've come from very humble beginnings be successful, and they want to preserve that success for their future generations, then we will do what we can to help keep those assets segregated, keep them separate, separately identifiable, not so much to say, hey, if you get divorced, this is what's going to happen, but more to say, hey, this is the gift that your parents gave you. And it's intended for you, of course, in your future generations. And the best way to protect that is to keep it in a separate account. And sure, if you want to pull money out to buy a car or take a dream vacation or put a down payment on a house, sure, go ahead and do that. But to respect this gift that, say, mom and dad gave you, then you want to keep that in that separate account. And that's why you do that.
No, exactly that. And especially family businesses that are ongoing, make sure you have a buy-sell agreement, and it has inside that buy-sell agreement what happens if an owner does get divorced,
Yeah,
because you don't necessarily want to be in a business relationship with your son or daughter's ex-spouse, and
right.
that's an easy one to take a look at.
Right, exactly. And then let's just touch on a special needs trust, because this is related, a little bit of an offshoot, but special needs trusts. I recently had dinner with a couple, and it's just a sad story. At age 62, she was diagnosed with Alzheimer's. 2 years later, at 64, she needs 24/7 attention because she is just not able to take care of herself because of the disease that has now taken over her. And at age 64, it's very likely, very possible that her body is still healthy, that she might live another 30 years and require 24/7 attention for the next 30 years, which brings me to a special needs trust. As long as spouse is here and alive and healthy, and he can either take care of her directly or oversee her care, then there's someone looking out for her. But what if he suddenly dies in a year? What happens to her, and what kind of trusts can be set up to take care of that spouse?
No, exactly. And anytime you have someone, whether it's a spouse or a child that's receiving governmental benefits, a special needs trust is a wonderful way to make sure that they have provisions outside of those governmental benefits that they need it, but that those assets that you're leaving for them don't preclude them from getting governmental benefits, and it doesn't all burn up before it can get to, the next generation. And so what you'll typically look like in that case is what's something called a third party special needs trust. And so husband, when he passes, might leave whatever he does leave to wife, not outright, doesn't take it and transfer it into wife's name, but would transfer it into a supplemental needs trust for wife's benefit. Again, the purpose of it is, it's there to enhance wife's quality of life. But what it's not there to do is to reimburse or supplement the governmental benefits because you do want to make sure that you're getting those benefits. Again, that kind of planning, and usually I'll refer clients to people that do it full time because that is a very specialized
Yeah.
area of the law.
Yeah.
But if you do have a beneficiary that you expect to receive governmental benefits or that they are receiving governmental benefits, it's making sure you take the time to structure the inheritance correctly. Because again, worst case scenario, you have that beneficiary and you leave things outright to that beneficiary. And now all of a sudden, to get the benefits again, they've got to deplete their inheritance. That's generally not what a family would like. They would like the inheritance to be there to supplement them, but not as a means of basically covering the government's check.
Yeah, and what I'm wondering as well, what I'm thinking as well in that same regard is making sure, so for example, this woman who is 64 who now needs 24/7 attention, if husband dies, he wants to make sure that there are funds there to keep her in an assisted living facility
Yeah.
and keep her in a certain lifestyle the rest of her life. And that would tell me that there's got to be some kind of a trust set up so that those monies can be pulled out for that purpose, and there has to be a trustee assigned who understands what the goal is and what his intentions are to carry that out for her for the next 30 years of her life.
No, exactly. And that's where it goes into the trustee selection. I mean, you'll see some people name their kids, and oftentimes the kids might be busy professionals. And you have to push a little back a little bit as an advisor and say, yeah, your kids obviously they love parents and they would do what's in their best interest, but do they have the availability to monitor that care or the expertise
Right.
to know what care is needed? And sometimes the answer is no, and we maybe should appoint, a third party to act as a trustee that's familiar with handling those kind of estates.
Yeah. And that was in the case of a spouse, but this also pertains to, say, a parent who has maybe an autistic child
Yep.
or an adult or an adult child who will never be able to take care of themselves the way we would like them to. So that trust for that purpose, a trust can be set up for that purpose for the same reasons, more or less, correct?
Yeah, it certainly could. And I'll add another example on that I've seen occasionally is sometimes it's, dad has passed away, mom is still living. Mom's capacity to manage things has gone down.
Yep.
And so can we establish a vehicle that will protect mom from, say, adverse parties? I mean, you see a lot of, stuff online about people getting swindled, from
Right.
somebody that said that they were something that they're not. That
Exactly.
does happen increasingly more, especially
Right.
with an aging population.
Right.
And so you will look at sometimes trust structures to protect mom from, quite frankly, herself in that case.
Yeah. 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 Romance scams preying on the elderly, and not even so
Yeah.
much the elderly, but preying on people are rampant. And we've seen some of that as well. Yep, they become targets and people go after them, and it's just not good. So what I'll do just really
No.
quickly here, if I can just wrap up just a little bit and summarize. So I'll just touch on quickly what we talked about in this conversation. So we talked, of course, about taxes, ways to mitigate the taxes, reduce the taxes, maybe even eliminate taxes when the family is going through this sale of a business. Talked about setting up trusts, that maybe trusts even set up in a state that has no income tax or reasons for that. We talked about trust in the big picture, about why setting up trusts in different states, in various states, might be worthwhile. We talked about the revocable versus irrevocable and how there is a common misconception that a revocable trust is asset protection when it's not. We talked about protecting adult kids as again that family goes through that sale of a business. We talked about sole and separate property, community property, trusts, how they can be beneficial to that family and to the kids. And again, getting to that big picture of the family, they have come from, say, humble beginnings. Now they've really knocked it out of the park. They've got significant wealth and they want to reduce taxes, protect the overall assets that they have, um, transfer assets to their heirs and their beneficiaries when they want to. They want to be charitable and share those blessings with the community and causes that they care about, and they want to have a life of significance. So I think that, Sam, the work that you do in the estate planning of that is just so critical in helping them carry out what they're trying to get to, that I really appreciate having this conversation with you.
No, I appreciate you having me. I mean, to your point that you said earlier about your meeting that had the business attorney, the estate planning attorney, the CPA, and then yourself, it really does take a team and it takes time, you know. And so families that are willing to have the team together, take the time to get it right, are the ones, in my opinion, that benefit a lot more than families that kind of, you know, that rush things. And
Yep.
it's tough, especially for business owners who focus on the business because that's the baby, you know, to kind of take time to do other things. But to the extent that, you know, you value mitigating taxes, passing wealth down to beneficiaries in a way that it's, you know, not an inhibitor, but rather rocket fuel, right? It gets them off the
Yep.
ground.
Yep.
Taking the time to do that right is vitally important.
Yep. Agreed 100%. Again, Sam, thank you so much for this conversation. Really appreciate it. And we'll put your contact information down below, your email and your phone. So if people have questions for you, they can reach out to you and they can reach out, of course, to me as well.
Awesome. Thank you for having me, Armando.
Thank you, Sam.